Chris,
Hi Andrew, how are you?
very well. How are you?
Good, thank you. You're looking very well, very dapper and very well groomed too, I might add.
Mate, I tell you what, I mean, we all look nice and calm in this environment, but unfortunately, I've just had to ask the family to vacate out the front door so I don't have kids and dogs around me, and a lot of panic goes into getting myself right to this point.
That's all that counts, mate. It's all
That's
the
right.
bit we see. And how are
That's
you
right.
coping, apart from the fact that you've obviously put on a series of these webinars, which has been well received by all accounts?
Yeah, thank you. Look, we're all going really well. I think we're one of the fortunate ones from a company point of view.
Yeah.
That we're all at home, have been at home since day one, just doing our job. And clients have been very supportive, and obviously markets have remained, in some people would say surprisingly, have remained pretty buoyant.
Mm.
Obviously there's road bumps ahead, but no, we're very lucky. And you guys a bit similar, or?
We got the Burke Street, the David Jones building. We got that acquisition through a couple of weeks ago, and I've got to say that was really hard.
Yeah.
And I think when you look at that example and a couple of others, when people are, I call it in isolation or lockdown, it's all right to deal with business as usual. But when when there's just that additional bit of stress or pressure, or things are going on, and you need collaborate. You need to sort of just casual conversations with people rather than everything being a meeting, a deadline, an issue, a crisis, or whatever it is.
Yeah.
You need to just be able to sit down with people and be normal and have normal conversations about stuff. And you don't, and that social part of it, which is how we all, I think, cope with or talk about issues or share experiences or share the pressure, share the load, you lose that.
Yeah.
So for it was probably a week or so after that, I think both Simon and I were, oh my God, like we sort of, you need to go into, just to have a bit of a break. You're just numb from it all. So that was hard. But apart from I'll call it those sort of peaks, the rest of it has been, operationally pretty good. We're all a bit sick of it, and missing the social interaction.
Yeah. Yeah, absolutely. I mean, and look, yeah, I'm sure you guys have done some things similar, and I can see the numbers kicking up. We'll kick off in a minute, everyone, but I think, and we'll talk about this obviously in this discussion today about work from home and what it means, and has there been a fundamental shift and so forth. I can only speak at this point from my team's perspective, and whilst we can do team activities on a Wednesday and do some health and wellness and well-being sort of stuff, pizza making one week, and we've got origami tomorrow. You can't beat the real thing, and our team are craving that, all the things you've talked about. They're craving getting back into the office and having the social interaction and so forth. And I'm sure a lot of your staff are dealing with homeschooling, which a lot of our staff are. And
Yep.
I take my hat off to some staff members, what they're juggling at the moment, work and home. It's phenomenal. So.
Yeah, we've got all of that. You can hear the piano lessons in the background, and you hear, the 2-year-old running around going nuts, and whatever it is.
Yeah.
I got to say, I think the nice part about it is everyone is relaxed and just tolerate. We accept it. Whereas it might have been a time where you go, no, shush, I'm on a work call, or this is, you can't give me away, because if my family's around, it makes people think I'm not focused on work or whatever it is. But I think everyone's very relaxed about the dog barking, the kids screaming, the piano going, whatever, chit chat in the backgroround.
I think I've got all my background noise controlled today, but if the dog starts barking, everyone knows why. But we'll kick off officially. So a warm welcome to all attendees today for the week 2 of the Hewison Private Wealth Lunchtime is Money webinar series of our 7-week series. So warm welcome to Hewison Private Wealth clients who are joining us today, and a particularly warm welcome to any non-Hewison clients who are just joining us today because of a level of interest. Some bit of housekeeping before we kick off. We're going to try our best to keep, well, we will keep this to an hour. I'm sure, Chris, you've got other places to be, and everyone else does as well. I believe at the bottom of the screen there's a Q&A little text box there. So we're going to answer some questions at the end of the prezzo. So jump on there, ask your question, and we'll address that at the end of our discussion. It's also being recorded, and you'll receive a link tomorrow to the recording if you want to go back. I will officially welcome Chris Langford, Co-Managing Director of Newmark Capital. Welcome. Thank you, Chris, for being here today.
Thank you for having me.
And I'll come back to a bit more of a introduction to Chris and Newmark in a second. Just for anyone, I can't help but smirk because the whole work from home situation, I've got a FedEx person that's about to walk past my front window, so I'll give them a wave. Just quickly for everyone who's not so familiar with HPW, we're an independent financial planning and wealth management business based here in Melbourne. We work very closely with our clients, groups, family groups, etc. To essentially, our job is to put strategies together, non-investment and investment, to achieve individual financial goals and objectives, whatever they might be. And one of the unique aspects which feeds into my discussion with Chris today is how we invest. We don't prescribe to a cookie cutter approach or a risk profiling type of approach. Every portfolio is constructed from scratch according to the needs of the individuals and whatever their goals and objectives are. And to that point, some people may or may not be familiar with investment platforms. Hewisons don't use a third-party investment platform. They can be somewhat restrictive at times, just around what you are able to invest in. And although we'll talk about it as we go along, Newmark do have the Newmark Hardware Trust, which is now, thankfully, it is available on platforms, but the majority of Newmark's private trusts are not on platforms, and if we were on a platform, we wouldn't be able to have the relationship that we have with Newmark. So moving on to Newmark, I'm just going to do a bit of a background, Chris, and you can add to it as we go along. But Newmark Capital is a property investment manager that takes great pride in its real estate focus, but with a particular regard to the long-term performance of an asset. Company was founded by Chris in 2011 with his partner Simon Morris, who have got a combined 50 plus years collective experience in every aspect of the property industry, from acquisition and operational management to development and refurbishment. And Newmark specialises in commercial property located throughout Australia, with particular interest in office, retail and industrial. And impressively, since 2011, Chris, Newmark now has a property portfolio in excess of $1 billion, which is obviously, extremely impressive as well. As far as the Hewison Newmark relationship goes, it's one that I think collectively Hewisons and Newmark are very, very proud of. It began in 2012 when Newmark approached us, or we met through circles, and Hewison clients took part in the investment of 417 St Kilda Road. And the Hewison directors were so impressed by the building itself that although clients it was sold and we don't invest in it anymore, but we're tenants of that building now. But it was a great example, I think, of how Newmark approach property investment. Our view of you, Chris, and your team is that we tend to think that you guys can see things in assets that others just can't. And they generally relate around the possibilities of the asset, value add, ability to renegotiate leases and increase distributions over time, etc. And I guess, 417, I think, started at a distribution yield to investors of about 7.5%, and that grew to 9%, and the property was sold in 2018 for a very handsome profit. And I know, Chris, you're a modest man, and I think you were quick to point out that we probably shouldn't expect the same level of performance across all your assets, because that was the first one and we had such a good experience. But the relationship has gone from strength to strength, and I think we now invest, or our clients now invest, in seven active Newmark Trust investments. So Chris, over to you. I'd love to get it, from the horse's mouth, just in relation to a bit of history of your career and how you came together with Simon to join Newmark, and also just touching on your general, philosophy as it relates to property investment.
Sure. Thanks, Andrew. Well, thank you for the invitation, firstly, to join with you and others today on this initiative. It's a great thing for you to do for the clients, and hopefully we can, I guess, provide some insights that are relevant and current. In terms of, I guess, the background, St Kilda Road as a case study, it tells a lot of aspects about Newmark. A lot of people looked at it, and I think, in 2012, as we can all remember, we were coming out of we're still in the grip, I guess, of the global financial crisis, and property in Victoria, and Melbourne in particular, was still propped up in many ways because of interest rates, and it was seen as a safe haven for overseas capital. And in the housing side of it, the first home buyers grant was still alive. So even though there were all these macroeconomic things that were driving, sentiment and interest rates and general mood, there were particular things that were relevant to St Kilda Road that didn't apply to the city, or didn't apply to shopping centres, or didn't apply to logistics, or whatever it might be. So, that was the case at the time in that situation, and it's the same today. Be it when we looked at we just bought a Burke Street property at the old David Jones menswear building, and Hewison's clients are obviously featured in that, which is great. Thank you for your support. But it's the same situation today, where we find ourselves in difficult times. There are all these macroeconomic issues going on, and there are a number of particular things that apply to different sectors, and you could say the same as we saw in 2012. So, we always look at those issues, and Simon and I met back in probably 5-6 years ahead of starting Newmark, and we were doing just joint venturing in developments with a couple of shopping centre type assets. And I think we both talked from a very, very early point about creating an investment management platform, and because we both were used to creating these assets as I call it the developer in the development part of the food chain, and then you take them you get them to commencement, or you create the asset, and then you end up selling them, and all the good work you've done goes to the next owner. And we very much believe that creating long-term value, you don't take shortcuts, and you do things properly. So it was more that sort of developed a whole approach that we both shared. So one thing and another sort of got in the way of that happening sooner. But obviously, when the GFC 2011 I was up in Sydney, we were in the grip of some pretty tough times in the property sector, and Simon said, "I found this great opportunity. We should start that business that we've always talked about doing." And I said, "You got to be crazy." Well, you can guess what happened next. So yeah, look, that's I guess the sort of the context of how and why we got started. I think it's fair to say that we didn't think back then that we'd be looking back in 2020 and talking about over $1 billion worth of assets and a team of 25 odd people and a pretty nice track record. But it's very pleasing to be able to do that.
And so I guess fast forwarding from the GFC and obviously some some positive years there with economic growth and property price growth, etc. We fast forward to the midst of a pandemic. So this question obviously can be split up because there's different subsectors within commercial property. But how do you see the current state of the commercial property market?
Well, you're right. There are a number of subsectors, and it's interesting. It'd be interesting to see how it pans out. But I think if you start with office retail, then you've got I guess industrial, which is split into two bits. One is obviously manufacturing, and the other one's logistics. And we don't see a great deal of manufacturing in Australia, but there's probably a fair bit of owner-occupier type of activity with food and a fair bit of that in that sector. But they're the main parts to it. There are other parts, data specialist properties, data centres, and there's childcare centres. There's government services and infrastructure, be it Centrelink or court buildings or tax offices and the like. And there's also then hotels and a range of other hospitality, pubs and the like, which are obviously being whacked enormously at the moment with COVID. But if we just focus, probably I'm best equipped to talk about office and retail. I think there's been obviously a big shift to and enthusiasm levels for logistics and industrial, or that sector of industrial. But I got to say, we think that the barriers to entry, there's a lot of land available that, you can have a really good logistics centre on a freeway out in the metropolitan fringes, but there's so much land generally available that there's very little to stop someone else from just creating a very similar property next door, down the road, pinching a tenant and so on. So for us, it's the real estate fundamentals of that are different, because it's not so much about the real estate; it's about the rent deal, the affordability, and those issues. And if you can control the tenant, it's half the battle. Mm. It's not so much about good long-term real estate investing, in our view. If you talk about office and retail, how's it going at the moment? Well, office is clearly been hit. We see it at Brandon Park Shopping Centre, where we have 84 specialty retailers, and a lot of the big client base there is the local workforce that come in for their banking, for their food every day, and that 5,000-6,000 local workforce is down. And even though the centre is obviously closed at the moment, when we had the sort of rebound in June and early July, the sales figures came back pretty quickly, but they were probably 20% down, and that 20% can be attributed to that, the share that comes from the local workforce. So it's one thing to say, the city is more affected than the metropolitan offices, and the city is certainly doing it tough, but they're generally probably bigger landlords and bigger tenants. But office has clearly been heavily affected, and it's around the cities. I think obviously, Melbourne's doing a lot tougher than Sydney and Brisbane and Perth. We've seen those states have handled the situation very effectively. Although it is interesting to note that, notwithstanding the low COVID numbers in New South Wales, the Sydney CBD is still pretty much empty. Mm. There are very few businesses that are encouraging people to go back to work in the city. So, notwithstanding those issues, medical issues, as I said, the market there is affected. Now, is that affecting rent collection for the landlords? Not to the degree it is in Melbourne, but it is an issue. And I think it's fair to say, it's the office sector is doing it very tough. And maybe we'll talk a bit more later about the working from home trends and how where that's going to end up long term. But right now, they're in a fair amount of pain and some challenges ahead of them. And in terms of retail, it's been interesting to see. I mentioned Brandon Park, that was definitely affected, but the rebound was very quick and very solid. Mm. And during May, we opened Warragul, the Bunnings and Kmart and the large format retail down there. That's held in our hardware trust asset you referred to, Andrew. That Kmart in Warragul, which is not in the town centre, but on the edge of town, in a high-profile site. That Kmart set records for the business. It's the best ever opening by a Kmart on opening day and opening week. So, we like to take some of the credit for that because it's a great site and we picked a good market and a very strong growth area. But we know there was a degree of that consumer sort of pent up demand that, people have been in lockdown, stage 1 lockdown, and they were ready to get out and people, wanted to, go and check out something new and had a bit of spending itch to scratch, and they went there and they did spend up, but that continues to trade very well today. Pleasingly, it wasn't just a one-off. That store is going to do a very solid first year, not just the first week or first month. The other sort of retail asset we've seen have a few ups and downs has been Taronga, and it's had more ups and downs, thankfully. The fresh food component there is really, going extremely well. We're getting turnover rent and outperformance from all of the fresh food operators, but obviously the dining operators are affected at the moment by stage 4, and they're forced to close. So issues there. But I think by and large, retail is faring well where it's food based. Obviously, the bigger assets that we're seeing with fashion and discretionary spending being forced to close, there's all sorts of issues and challenges there. But our food-based convenience assets are holding up very well. And the large format retailers like Homemaker Centre at Chadstone with Bunnings and Good Guys and JB Hi-Fi, Freedom. I mean, they're having a great time of it. I mean, Harvey Norman's figures this week said it's the best retailing environment they've ever seen. And for people, because people are spending so much time at home, they're spending their money on home improvement and making home nicer.
And that's interesting, I suppose. Talking about, I just saw earlier today that the economic figures have come in for the last quarter, and we've seen a fall of 7% in economic growth. So that really, which is the worst on record for any quarter, which obviously confirms what we all know, and that's we're in the midst of a recession. Yet it is quite incredible to still see, people still wanting to spend their money. And I guess just in terms of retail, it's I guess something for a question or a comment from you just on the online shopping sector. I mean, obviously JB Hi-Fi, I believe we're in stage 4, hopefully coming out pretty soon. Like they've been offering click and collect and so forth. But it is interesting to see things like Kmart, etc. I mean, whilst people could shop online for Kmart, Target, and so forth, they're still more inclined to actually go in. So it also, not necessarily, it just speaks to even that overall sentiment we were talking before about, about office workers keen to get back into the office. I mean, we're all social animals. We're not going to live indoors forever. And at any opportunity to get out, even whether it's a shopping centre or not, it seems like we're still going to be really keen to do that when we can.
Oh, look, I think so. Look, I mean, we're social creatures. Humans love to gather, be it around the market square back, in the medieval days, or, in the malls and the food courts and stuff in more recent years. And I don't think that changes. We like to gather, we like to check out other people, check out the latest news, check out the latest product. We do those places have been created partly to service a need, but partly as a response to basically human preferences, people's preferences. And online shopping, online retailing is a feature, and it suits some sectors very well. But there's many others that it just doesn't work for. It doesn't work for. And if I could anecdotally sort of roll off a couple of examples, but again, Harvey Norman, and I don't have a huge regard for everything Jerry Harvey says, but he did make the point that I think their online businesses may be up to 10% at the moment, but he doesn't make any money out of it. And he doesn't think it's a big part of his future.
Wow.
Because it'll find its own level, and it is what it is. But it's not the be all and end all to him. He's doing it because he has to have some presence. And if people want to do a compare and they want to buy a particular type of fridge or couch or TV or whatever, or carpet, and they want to do a price check and they know what they're looking for, well, it serves a function in that regard. But generally speaking, people want to go and look at it. If you're wanting to buy a fridge or a washing machine or whatever it might be, you can do it online if you know what you want, but you generally want to go and look at it and just make sure that it's the size you thought it was, or that type of issue. You don't want to surprise when you open a box.
Absolutely.
So, that's one example of a category that the appliances online is a very good, successful business. And there are plenty like that, but generally speaking, people still want to go and check it out. Same with various things with food, different things with apparel. If you know the brand, you know the product, you know your size, and you know exactly what you want, then maybe you'll go looking for it. It's there. It's a part of our multi-channel sort of retail industry at the moment, and it's around the 10-11% mark, I think, across the board. I think there are probably some sectors where it's higher than 11 and some where it's a lot less. And that is, so it's not a universal answer to the future of retailing. And one of the things I've said recently when we talk about the Burke Street property is that, there are a lot of international retailers who've come into Australia, like H&M and Zara and Uniqlo and Muji and Sephora and others like that. And what they've taken in terms of market share is a lot more than 10 or 11%. So those guys have been a lot more active in their sector of apparel, of taking market share off people like, Solly Lou's businesses, be it Country Road or Just Jeans or Peter Alexander or whatever other sectors there. Also the David Jones, Country Road, Witchery, Politics, those other brands. Those guys have lost a lot more than 10 or 11%. Not so much to the internet, but to the international retailers. So there are other factors that I think are as much of a threat, if not bigger threat, than online.
So, okay, so just on that, let's stick with retail for a second. And we're not going to go into too much, specifics around the Newmark investments today, but let's just deal with, say for example, Burke Street. If I'm an investor and there'll be some client, I've got my own money in it. That's how much I like it. And a lot of clients who are on the line today probably will too. So that deal's just been done, and you probably would have been looking at that for quite some time. The deal was done in the middle of COVID. And again, it's quite a unique one, I think, because it's sale and lease back to David Jones for a period of 2 or 3 years. And then you've got a belief that there's going to be some opportunities to increase the lease and do some value add. Now, the way that you're still having conversations at the moment without letting too much out, are you still getting a great deal of interest from, we'll call them marquee brands that really want that presence on Burke Street? Like, has anything changed in relation to their attitudes?
You mean through COVID?
Yeah. I mean, obviously David Jones is still there for a period of time, but looking to the future, has your intention is still going to be to relet that space to brands, whoever they are, that want to be, want a presence on Burke Street? What's been the conversations like, if you're having any, or just has there still been an appetite of interest there coming in, and has it changed at all during COVID?
Yeah, look, it was interesting. That deal took probably best part of 6 months from us putting our offer in February, and then settling it in early August, and that I mean, our world changed a lot during that sort of for phase one, opening things up again, and then lockdown stage 2. But it's been and I guess 2 things. First of all, it was a 3-year lease back with David Jones on the original terms. Meanwhile, and this is all happening in parallel with us doing due diligence, dealing with the contract, and and obviously putting our offer document together and getting to settlement. But the feedback from the retailers was very clearly, we don't want to wait that long. If it's a 3-year lease and then you take maybe 12 months to do the refurbishment work, we can't wait 4 years. We want to be there sooner. So that led us to then go back to David Jones and say, we need to renegotiate this lease back and have a shorter term horizon. We're going to cut it back to 2 years, which they agreed to because it was consistent with some of the the announcements that they'd made at the time. So again, that took a little bit of delay, made a bit of a delay because we had to then go back and renegotiate those terms. And that's what we've ended up with, effectively a break provision that allows us to get them out after 2 years. So that was driven by the strong feedback from those retailers we've been talking with. And answer to your question, has their interest changed? It's got better, to be honest. It's got better because now we own the property, we can talk to them properly.
Sure.
And whereas before we were sort of having high level expressions of interest, we've already got an offer from one operator. We've got another operator who has gone from we hadn't even spoken to them until about a month ago, and they've gone from pretty much a standing start to leading the field, and we hope to have a proposal from them in the next couple of weeks. I'll tell you what, I can't tell you now what it looks like, but and then another group who we know had even inspected the building last year before it hit the market because they'd heard it was coming up. And we're putting a submission to them in the next couple of days. So, the feedback has been good, and now that we've engaged more meaningfully with them and can see the whites of their eyes, it's genuine and it's strong. And I think they're looking at 2 and 3 and longer term time frames. Some of them have already a presence in the city, and so they're making plans to exit where they are and move, or they're not there and they are trying to get set, and they've been trying to get set for multiple years, sure. some many years. But so they're looking through. I imagine you could say with a sort of post-COVID sort of mindset, they're looking through this, and they know it's tough and they know it's difficult for now, but they fully expecting things to revert to business as usual within a year or two.
Great. Now, I'm going to ask the question that I'm sure a lot of clients are asking us at the moment, and I'm sure you've been asked numerous times now, but does Newmark have a view on whether COVID-19 is going to sort of permanently reshape the office market due to more flexible work arrangements and so forth? And if so, I mean, where would you see that being more impactful? Is it size of building? Is it location that you might see impacts going forward? Is there anything you've seen so far in the market?
Yeah, look, I think it's undeniable that we've all adapted very quickly and very successfully to a work from home arrangement. So there's absolutely no doubt that you can do it. But having said that, where it is 100% of your life and your working life, it is clearly not universally popular. And I think a lot of the conversation has been, I'll call it swayed or slightly influenced by a particular part of the workforce. And I don't want to generalise, but I got to sort of be slightly more contextual to make the point. But if you think of a white collar professional in their young, early stage of their career, they might be in their 30s, they might have 5-10 years under their belt, and they're not necessarily married, they don't necessarily have family, kids. They're fairly independent and flexible in their own arrangements. Now, for those people, and they might want to travel, and they might want to do a bunch of things with their career plans at that stage of their life. I mean, I think I think a lot of the conversations we've heard around work from home, it's sort of geared with that idyllic, ideal target audience in mind. And I think, yeah, fine, it works. And a lot of the people who work for Newmark who are in that, I'll call that age bracket and that sort of life description, would all say to us on a regular basis, oh, we want to work from home, we want to do this one a day or two a week or 3 days a week. So I think that, yeah, it's proven that it works. It's proven that people don't go off and play golf or, do social stuff or go to lunch just because they're working from home. Maybe that's just because golf courses are closed at the moment, I don't know. But it's we've all seen that it can work, and I think it will feature in the future. But when you look at I'll call it the wide range of the balance of the workforce who don't fit into that narrow description I just had, of people who are, maybe got kids who are at homeschooling, or you've got single people who don't have, family and friends, and don't have, they miss that interaction of their work colleagues. They miss the social aspect of work. They want structure. They want feedback. They want direction and guidance and assistance. There is, and we've got people like that, and we see a lot of people. We deal with a lot of people like that, and we know from their needs are not met by, and wishes are not met by working from home. And the other end of the spectrum, and I've talked about this regularly with quite a lot of the people we work with, and be they either law firms or the big accounting firms or real estate firms, a lot of these guys have graduate programs, and they put on 10, 12, 15 people a year, and sometimes even more, and it's a big part of their life, and they literally have, obviously the career development, mentoring. You can't do that working from home. You can't have a graduate, literally shadowing you or learning how to be an analyst or a graduate lawyer or audit or whatever it might be, in doing that, eavesdropping on conversations and coming into meetings and picking up on things and doing that for 2 or 3 years. So, there's a whole range of things where you look at it and it doesn't necessarily work and fit.
Yeah. And I think,
I guess, sorry, just to close out, my overarching comment is that, and I've heard it said by people, that if you kill your office, you kill your culture, and you turn your staff into consultants. And I think, I know that's a headline of a throwaway piece, but I think that's a good way of sort of summarising the points I was just making about, the wide range. We have a diverse demographic of people in our team, and I'm sure you do too, and most businesses do. And it works for some, it doesn't work for everyone.
Yeah, and I think just an extension of that is, there's no doubt what we've seen is like Hewison and I'm sure Newmark and quite nimble businesses, and are able to offer elements of flexibility to their team. I think that's it's given people, some confidence, businesses some confidence to understand that adding offering flexibility to their staff doesn't mean that you're giving them a day off or a free pass. And it just, I think it's going to, I don't think it's going to result in some respects, some larger businesses maybe, but smaller SME type businesses, I think it's just going to add a string to their bow in relation to the confidence that they have in John or Jane to be a little more flexible working from home, and whether that might mean coming in a bit later and leaving a bit earlier because they're doing work from home to beat the traffic and things like that. I think it just adds an element to that culture, to say we have a culture of empowerment and autonomy, and we trust you to do it at home. We know you can. That doesn't mean we're going to give your seat in the office to someone else, because you still need to, you're still going to be here. So I think that's how I'm not the specialist here, you are, but I think that's how I'm sort of starting.
No, I think that's right. And I think apart from our businesses and the systems and the people we know well, the other thing here with Como in particular, we've got big advertising marketing firm in Clemenger. We've got a bunch of family offices. We've got small, medium enterprises, as you described. We've got Channel 10. We've got a very different range of businesses, from the literally incubator size through to medium and larger. And we have, in that whole spectrum, how many of those groups do I see that would fit into the work from home and adapting readily? The answer is very few. I think, obviously some of the, you could come up with rules and exceptions to it very readily, but I think they all fit into the comments I made earlier, that as you've said, it's a feature we can all adapt to, but it's not going to replace the office. And do I think any of those guys have, particularly, I'll call them cozy seating arrangements where they might feel, oh, look, we need to spread out more because we need to socially distance. There probably aren't many, if any, but I don't see that any of them are going to say, oh, we're too big and we want to hand back space because, we're now going to have a different arrangement post-COVID and we need 20% less office space. I don't see that happening either. I hope I'm not going to be proven wrong on that one, but I don't see it as a huge issue. I think the biggest issue office is facing is the recession you referred to earlier.
Okay.
And business confidence. And, we've seen a lot of the conversations we've had with existing and proposed tenants, office tenants across, the last couple of years for the various properties we own. There was always this view about growth. This is where we're at now, but we're growing, we're going to need more and we need expansion space or provision for this or that. I think that's the issue, is that people aren't going to be now coming the next year, 2 or 3, and coming to us and saying, oh, look, we need to grow and we're booming and we're doing these things and we need more space. I think that's going to be the issue, and that's going to affect the whole of the market. And whether it affects us directly with this tenant or that tenant, we will get it indirectly because it will just slow down the office market and it will slow down rental growth and it'll affect incentives and leasing deals.
And a point that I'll make, because I think it's really important before we move on, I guess, is that's why groups like Newmark and then, of course, financial planners like Hewison's always implore our clients to take a long-term approach because, since 2011, we've all had the benefit, particularly with Newmark assets, of seeing them every time there's a revaluation, there's steady jumps. There could be a revaluation period coming up where there's not another jump. There could be a leveling out or a slight decline or something. But of course, that's why you invest for the long term. You can't always have it, the upward trend. You expect that over the long term, you're going to get, couple of ups and some downs, but hopefully a smoothing return, which is in a positive direction. So I think it's a very important point to make.
Yeah.
Okay, so on to another question now. Could be an anticlimax to the answer, but we'll see how we go. Whether now or further down the line, the recession. We're talking about COVID, but I think the recession, to your point, is probably going to be the bigger issue. Do you expect to start seeing some quality opportunities in the market? So whether it's now or down the track, if you had your finger in the air, sort of testing the wind, what direction are we going in?
Yeah, look, it's interesting. There are definitely going to be opportunity. There will be opportunities, whether they're the quality that we want. I'm sure there'll be something. Now, whether it's going to be, I'll call it the distress sort of category, or just we've got someone who wants to sell category. We had a conversation earlier today with someone from one of the banks about how their clients are feeling, and the comment was made. They're probably, a few of them think the next 6 to 12 months there will be some distressed opportunities, and they're going to be sitting back waiting for that. And we sort of said, well, and they asked us how we felt about that. We said, well, we think it might be possible, but it will depend on the attitude of the bank. So the bank's going to start to tighten the criteria and apply the pressure. To which the answer was no. They're told, the government is putting a lot of pressure on the banks to keep them from doing that. How long that lasts can't go on forever. It won't go on forever. So there will be issues. We've recently read about the iProsperity, fraudulent behaviour of those guys. So there's going to be a bunch of hotel assets hit the market, and they'll be selling cheap. Now, whether you want to buy them or own them is another matter. So there will be things like that come out, and there will be under the category of distress, and there will be things like that regardless. We thought there might be some quality retail assets that would be coming up recently. We put an offer in on a couple of assets that one of the bigger landlords who were under quote unquote pressure from the market to be seen to be doing something, and that literally went to their board, and the board said, no, well, those assets are actually performing well for us, so we'll hang on to them for now because we need the income they're producing, the solid income. So, you know, there are definitely shopping centres you can buy around the traps. So, you know, we've had conversation with people go, well, gee, everyone's down in the dumps on retail. There might be some good counter-cyclical buying opportunities there now. And I look at that and think, yeah, well, there's certainly logic to that, some merit to that logic, and you know, worth looking at. But to be honest, there aren't that. You know, if we could buy another Brandon Park or two or three, we'd be there tomorrow.
Why is that?
Because you're getting large land holdings in a, you know, the strong demographic and a good location,
yeah.
And you're getting paid to hold great land. And the fact that you might have, I'll call that the retail word associated with it, is what seems to be putting people off, and it seems to put off banks and a bunch of investors. So from our point of view, we think that's crazy. If you look at if you're looking at buying real estate and you're looking long term, and you're getting paid a reasonable, you know, in a low interest rate environment, you're getting paid a reasonable return to hold this really good land bank that one day could be office, it could be residential, it could be mixed use. Well, that's what you need to look for. And if it's, and we think that's the case with Brandon Park. So if you could find that and buy that, well, we would.
Yeah.
The problem is there aren't that many of them. You know, not every shopping centre has the same attributes. So it's either in the wrong or a lesser quality location, or it's in regional towns, or it just doesn't have the features. So if we could find, and we will look for them, and we've got some ideas, but whether they're going to come up or not, we don't know. But yeah, there's one thing about, we talked earlier about the distress, but there's another thing about, does it fit our view on a good investment or real estate fundamentals? And the other sector is going to be hospitality and hotels. And there could be some opportunities now. Whether that's a fit for us, I don't know. But clearly, you know, we're seeing real pressure on that sector now, and I think it'll rebound. And I think, you know, some of these hotels are clearly incredibly well located in central or strategic locations. So, you know, we would look at that, but I don't think we want to be exposed to the ups and downs of hotel businesses.
Sure. Well, I'm nearing the end of my questions, and I see we've only got one question down here in the Q&A box. So if you've got any questions, I'd highly encourage you to pop them in the Q&A box now for the viewers. Just a very, very quick one, Chris, before I go on to my next question. Within the Como asset that's managed by Newmark on the corner there of Toorak and Chapel Street, obviously the part of that is the Como Hotel. Has that? This is just a bit sort of off the cuff, but you've just raised it. I mean, how have they been? Obviously, they've been hugely impacted, but I mean, they offer out a couple of floors to as a maternity ward. Have they tried to increase that at all, as to try and keep the rooms full or anything like that?
No, they've been really heavily hit, and since Cabrini have done their new wing and opened up at Wattle Tree Road, Malvern, they've actually ceased that deal at Como, which is disappointing, I believe. Yeah,
my wife and I would have been one of the last then to get in 10 months ago. It's nice.
Yeah, that's it. Yeah, you would have been near the end, but no, they were very, very hard hit back in stage one, lockdown one, and then after, you know, things were relaxed before the borders were closed down, they were, you know, around the 10% occupancy, and you sort of try and figure out how they even got to 10% because there was no one around. But since then, the Defence Force, who have been shipped down to Melbourne from Canberra or wherever they've come from, or New South Wales, have been staying there, and they're full. So at the moment, they're going okay. But from an investment point of view, we have a lease with Accor, and that lease expires next year. So I don't think they'll be keen to sign up for a further term on that lease. And I think they will want to, you know, convert that to a management agreement. So we've got some work to do on that to come up with a maybe a balance or a hybrid model in between for next year. But that is going to be yeah. At the moment we're thankfully insulated from those ups and downs of its occupancy, but that will change next year.
Sure. Looking at the Newmark, the Newmark portfolio of assets, which I think for viewers, for listeners today, whether you're an investor in through Hewison's in any of the Newmark trusts, or whether you've got assets, I mean your portfolio, I see it as being extremely diverse. So when you're looking at your assets across the board, just would love to get a bit of a flavour for what you guys did or have done during this COVID situation, to manage your assets and also support the tenants throughout COVID to get the best outcome for everyone when all this is finished.
Yeah, well, I think we like to, well, we say it, but we also like to do it. I mentioned before Como having the incubator, the medium business, and the bigger businesses, and we sit down with all of them, not just the big guys or the medium ones or the ones we know, but and we work with them pre-COVID. So we do that as a matter of course. That's just general run-of-the-mill business with Newmark, is that we understand and have a relationship with the tenants and understand what their business is doing, what their needs are, where they're going. It doesn't matter if they're a retailer or an office tenant or a hotel or whatever it might be. That way, we think we can help them to, and the assets to better suit each other, and obviously we can accommodate their growth and their needs as the business change and evolves, and the assets can then evolve with them. So, and we think that's really important to tenant retention. We've got we're very proud of our rate of retention and renewal across all of our assets. So we do that. We've done that from the get-go and work with the businesses and have good open lines of communication. So obviously when COVID has come along and people have been affected, some of them had issues pre-COVID that, some of them, are using COVID to sort of hide behind or, get rental support or assistance that wasn't really due to COVID. It was due to other issues that they were already experiencing or self-inflicted. So, we've had a lot of claims, and our guys, just the workload of administration and then the government's code of conduct, it didn't help things when the Prime Minister came out and said, if you're having troubles, don't pay your rent. And treating all sort of landlords as sort of greedy fat cats. From our point of view, obviously, our clients and your clients are the ones who are affected by those sort of statements. So, and we don't fall into that category of being, people who can afford to just sort of, gouge on rents and can afford to provide subsidies. And we've made that really clear to a number of the bigger businesses. Our business is collecting rent. If you don't want to pay rent, you're impacting our fundamental business. So, we've had those sort of conversations with the tenants in our portfolio. It's fair to say that I think Como by number has a large amount of tenants, and obviously a lot of conversations, every deal on its own merits. And Brandon Park, similar, a lot of tenants in that centre that made it up. And I think there were 76 requests for rent relief there, and we're working through them. For the first round of lockdown, and now again a second round, have to deal with it all, start again almost. Como, I think, is reasonably under control, and Brandon Park, they're the two bigger. Taronga, there's a few here and there, but I think those guys, there are three categories: people who are just taking advantage of getting a rent holiday because the government said they could. Those who have been affected by COVID, and those who were affected before COVID came along. And we think that there is clearly going to be a reduction in the amount of rent we can collect. But by and large, we've been very transparent and as I said, trying to, generally, you want to categorise the deals, but each is being done on a case-by-case basis. Yeah, and because we have those good relationships with the tenants, we work through it. and we're still working through it. And there's still probably another 50 to 70 deals that we're working through now across the portfolio to deal with each of those cases. But if it's a retailer, it generally relates to their trading performance or their forced closure and those issues. And we will come up with a rent deal that reflects the impact on their business.
Yeah, fantastic. Thanks for that. I'll jump to this question now. It's from David. His question is, when JobKeeper and JobSeeker get wound back in a couple of weeks, but in Melbourne, obviously there's an extension, and I think it's going to the extension across the board is going till March. What is the risk to the performance of retailers such as Harvey Norman and Bunnings? And therefore, what is the potential to a hit to the valuation of the property trust portfolios, such as Newmark's Hardware Property Trust?
I don't think it's going to hit the trust. I don't think it hits valuation. I think if the businesses and clearly it was interesting to see Harvey Norman disclosing the amount of money. I think it was $40-something million they got out of JobKeeper for the relevant period, or whether that's post. I assume that includes post June. But there's no doubt that JobKeeper is helping businesses, and some who, as I said before, some who are just happy to take it. They weren't expecting it. They don't necessarily warrant it, but they get it and they'll take it because it's there. And those who genuinely need it. So, if you focus on the second category, not the former, because I don't think the big guys are going to impact their ability to pay the rent. They're doing the sales. They're performing well. I don't think there are many of our tenants in our large format or hardware trust category that are going to be anywhere near impacted. I think JobKeeper is playing a part, bearing in mind only one of our properties in the hardware trust at the moment is in Victoria, and that is in the one in Warragul, and that is in stage 3 lockdown. So that is still, they're still trading. I don't think the JobKeeper is definitely playing a part in the economy. It's definitely playing a part in assets like Taronga and Brandon Park and helping the retailers, but it's not. I don't think it's an issue in the hardware trust. If that's where the question specifically lies, I don't think we'll be looking at any issues there. We've been back to the valuers at June 30 and reaffirmed or asked them if there were any doubts or issues with the valuations of hardware trust and all of the other properties for that matter. And even though Brandon Park had been revalued in January, February from up $14 million or up about 10% from its purchase price, the valuer said at June 30, post-COVID or mid-COVID, still very comfortable with the valuation. So there might be some adjustments about making a provision for a rental incentive or a rental temporary drop in income, but not to the ultimate valuation of the asset.
Yeah, sure. I like this question that's coming up, Chris. It's a bit of a curly one for you. It's from Kay. Before COVID hit, and again, you can speak to whether the truth behind this or not, but before COVID hit, the Como retail precinct was in significant decline. What will you do about that space?
I like the way you're smiling as you answer that question.
But it kept you on your toes.
Yeah, no, thank you. Thank you very much. Welcome. Look, pre-COVID, it was declining. I think it was declining before we bought it, and it's been in decline pretty much since the 90s or since Sports Girl left on the corner. A long time ago, it's been in decline. But what we have been doing over the pre-COVID and during COVID has been a couple of minor tweaks and changes to it. We've obviously the Cocoa Black opened on the corner early this year, it was late last year. Maker Coffee has now opened a couple of doors down from that. Again, it's pretty small, but very popular and trading very strongly. Cafe. We have a couple of food operators lined up to go into the next few tenancies along Toorak Road. So they're currently occupied by fashion retailers, and we have agreements ready to go once we can get on site and do the fit out works for restaurants and dining options in those tenancies. Right now, whilst we're in lockdown, the tiling is happening in the internal mall or the gallery inside there. So that retail arcade will look and feel very different when people, come out, well, when the works are finished, which will hopefully, it won't be too far off, but hopefully lockdown will end before then. So there is works happening there, and there is a gymnasium, a brand new gymnasium that's opened up on the first floor, it's going to have very prominent signage, and it's going to trade very well and be very busy. It's called Barry's Boot Camp, but unfortunately they finished the fit out just when gyms were forced to close back in May. So that's literally brand new, sitting there with the wrapping still on it, ready to be revealed, and that will I think change it. We want to have a couple of shops facing the street, and we want to reposition it. And rather than saying it's a retail component, within Como, it will be, things like gyms and restaurants and the cinemas, and a couple of shops facing Toorak Road. And that will be it. We're not trying to have an internally focused retail component. It's really just some services and some shops facing the street with the gyms and the cinemas, as I say, and the dining.
And to speak to that from Hewison's point of view as to why we were so positive about that investment. I mean, it's such, people look at the length of Chapel Street and look at the individual retailers and they see vacancies and so forth. But a Como asset is so diverse with the office, the hotel, the restaurants, the food court, and the retailers. So, and I think even though you look at what might be happening in some areas up Chapel Street, I mean, one of the things we really liked about it was, I think you guys said to us that South Yarra train station, being a couple of 100 metres up the street, is the busiest train station outside of the city loop. And the demographic of people that are living in that area is it's a younger demographic, but it's where people want to be. And I mean, even though you've said it's been in decline since the 90s, I look here and can confirm that from a unit price point of view, and I think the asset itself has performed even better than this, but unit price point of view, it's up 28%.
Yeah.
And pays 7 or 8% per annum in distribution. So it's a high performer in that sense.
It is a good performer. There is no doubt there are some pretty lumpy income payers in that mix. So I'm not going to just sneeze at it or dismiss it, because we want everything working. We want everything done properly. So I'm not trying to wriggle out of this one or move the spotlight away, but I just point out that retail component makes up about 5% of Como's income.
Yeah.
It is the bit that people see. Okay. Now we like the bit that people see, the public face of it. We want it to be good. We want it to be a better standard. We want it to be vibrant, and we want it to be fixed. But so I'm not trying to avoid the point or take no responsibility for it. We want that done, and we're not happy that it's taken us 4 years to get to this point. But as I said, literally the tiles are being laid today on the floor down there. There'll be new lighting, new signage, the decor, the painting, all those things that are part of it. And when you go up the escalators to the office lobby, there'll be a concierge desk and a completely new feel to the whole arrival and entry experience. And that's the public-facing piece that we refer to, and we want that done. And yes, we'll have new dining options, the gym, the cinemas, and they do pay good money. But it's 5% of all the money we collect. It's not the engine room. It is the face of Como, but it's not the engine room of where the income is produced. That is very much in the office, and that's that's thriving and going extremely well. We're pleased with that, but we're not pleased with, and we're not accepting the fact that the retail isn't fixed yet and isn't performing. But stay tuned and be patient, please. That will be in the next few months. It will be much better shape.
Sure, great. Question here from John. It's John Hewison. I'm sure he won't mind me saying it. It's John Hewison. But with the apparent shift in residential real estate away from the central urban area, green change and sea change, in the wake of COVID, do you think there will be a further decentralisation of office and conversion of inner city office to residential?
I don't think so. I think Melbourne is growing at a rate of, or was growing at a rate of knots. I think we need to just let the dust settle and see what happens. And migration was a big factor in Melbourne's growth. So I think there is no doubt that some people who are in fortunate position to have a choice can get that lifestyle balance. That will take some people away from the central areas. But I think planning at both the state government and the city council has been very successful. Melbourne and its inner city life, inner city residential population, inner city student population, and the Docklands and all these things have been a huge part of Melbourne's cultural success, the lifestyle, the comedy festivals, the sporting events, and obviously dining and food are a big part of that. And those things are, and having a really vibrant inner city life is what makes Melbourne unique and successful and popular. And I don't think anyone is going to want to undermine that. So notwithstanding the fact that there might be people who are choosing to do things differently, I don't think the government are going to want to have any fewer people working in the city. It was interesting, Josh Frydenberg's comments the last few days about how Victoria, is effectively going to be a drag on the economy if we don't open it up and get things going again. I think it's very important that from an economic point of view, to get the city back to life and to get the city performing. So I don't think the government or the planners will want to do anything that discourages those office buildings being office buildings and being part of that economy.
Yeah, fantastic. Look, there's no more questions, and I'm conscious of time. We're on an hour at the moment. So, look, just to wrap up, Chris, I'm just interested in some of the comments you made. I was interested to learn that even still, only 10% of Jerry Harvey and Harvey Norman sales are from online, which I'm sure a few of us would be surprised to hear. And it's just really interested in your comments around the fact that, and I think it's natural. We would all realise that, humans aren't people that want to hide in their homes, particularly in a beautiful city like Melbourne. We still want to get out and congregate and be in those social settings, in shopping centres, etc., and have experiences. Really positive to hear that the retailers are still looking through COVID in relation to that Burke Street asset for the future. Love the comment that you made about kill office, kill culture. I mean, work from home obviously can work for people that don't have a particular culture, that makes their business successful, but vast majority of businesses do and rely on that culture to thrive. And I just, I think it's a great message to send that question I asked around why more retail, and your response, which essentially was around, who wouldn't want to hold high quality parcels of land in quality areas and get paid to do it. I mean, not much more to say on that. So Chris, thank you so much for your time today. It's been fantastic. We should do it more often.
Good on you. Thank you.
I'm sure we've all appreciated it.
Thank you very much. Great to be part of it, Andrew. And it was a great initiative and lovely to talk as always.
Fantastic. And just finally, for everyone who's still on the line, we crack on with the webinar series next week. We've got Hewison director Simon Curtin and advisor Piers Hanlon. Their topic next week is investing for income, looking at the impact of COVID on income generation, looking at the ability to generate, how the ability to generate income is changing, and what we expect moving forward and what it means for portfolios. So the link will come into your inbox, everyone, tomorrow to register for that one. Always encourage everyone to get in touch. If you're a client, you can contact your advisor. If you're not, jump on our website, our LinkedIn page. We're very, very active on social media through LinkedIn and Facebook, etc. Always available there. I am too, Andrew Hewison, one word across those social channels as well. So again, Chris, thanks very much for your time, and we'll catch you soon. And thanks everyone for listening.
Thanks, Andrew.
Cheers. Bye.
Thank you very much. Thanks, everyone.